When acquiring an Indian company, the most common form of acquisition is through the acquisition of shares. If you acquire an unlisted Indian company, the capital gains that arise on the seller will depend on whether the transaction or the transfer is in the nature of a long-term capital gain or is it a short-term capital gain. Generally, for resident investors, long-term capital gains are chargeable to tax at 20%, whereas the short-term capital gain will depend on the seller. So if it's an individual, the rate could be 30%. If it's a domestic company, it could be either 22, 25, or 30%. In all such cases, this has to be increased by the applicable surcharge and the cess. However, if it's a non-resident, then the long-term capital gains can be taxable at 10%. Important thing to note for long-term capital gain is that whereas in case of a resident, there's an indexation benefit available to take care of the increase in the value due to inflation, for non-resident opting for 10% tax rate, there is no such adjustment for either inflation or the fluctuation in the exchange rate of the capital gain. As a buyer, what you also need to be aware is that you need to ensure that if you are buying the shares from a non-resident, you withhold applicable taxes. Because if you do not do that, then it is your liability and you can be called upon to pay that amount to the government of India. The buyer could be a resident or the buyer could be a non-resident. If you are purchasing it from another non-resident, then these obligation to withhold tax would be equally applicable to both of you.